I just noticed that the recording.
Yeah, I'm going to start again. So it's Henry Katarna. Welcome to this workshop. It's called Are You Investor Ready? It's a 6-hour workshop put on by CAST. I'm a CAST EIR. I'm an angel investor. I'm a mentor to CEOs, and I personally have invested in 22 technology deals. So I'm very pleased to be working with you today on this workshop. This is the second day of this workshop. So on the first day, we did 2 of 6 modules. The first day we did the process of negotiating capital, and secondly, the life cycle of the business. Today, we're going to do 2 additional segments. One is called deal structure. So the first hour of today will be spent on deal structure. I have a lot of different topics there. And then later on, the second hour today, we will be talking about valuation and various concepts about evaluating the value of your business so that when you are dealing with investors, you have an excellent top quality negotiation. And next time we meet, which I believe is next Monday, we're going to be doing segments number 5 and 6 of the 6-hour workshop. Number 5 will be the profile, the mindset, and the various kinds of investors that are out there in detail. And number 6 will be other topics such as how to do due diligence, how to set up a deal room, how to set up a term sheet, preparing the investor package, and the different kinds of slide decks that you should have ready when you are talking to investors. So once again, today we're going to talk about, in the first hour, deal structure and different types of details about that. And then secondly, the valuation process. Excuse me. And so we'll begin. Dale, I know that you will just interrupt me, please, whenever you like. And if I haven't caught that you're interrupting, don't hesitate to use that raise hand function, and I'm happy to answer any questions. And for Harumi and Sammy and Jordan, who watching this on video, I'm happy to receive your emails or phone calls. So my email address is H2, the letter H, the number 2, at katarnacapitalcorporation.com. H2 at katarnacapitalcorporation.com. And my phone number is 403-630-1781, 403-630-1781. Happy to take your questions or calls anytime during this workshop and in the days following. So thank you for all of that. So let us begin then. I'm going to talk about deal structure today, and there's a lot of different topics here. So I'm going to, first of all, I'll mention what the topics are so that you can have a sense of what we're going to talk about and possibly prepare any questions you might have. So we're going to talk about the different kinds of shares. We'll discuss the cap table and what it is and how it should look, options and warrants, different forms of debt, different forms of equity, different types of financing like milestone-based financing, the minute book, the unanimous shareholders agreement, setting up holding companies and operating companies, where to lodge your IP, anti-dilution mechanisms, loans, dilutive and non-dilutive capital, classes of shares, types of shares, and so on. That's the first hour. We're going to spend a little bit of time on each one of these topics, and there'll be plenty of availability for questions as well. So I'm going to begin by noting that when you are a company looking for investment, you need to be familiar with how your investors will approach you. And they will approach you with a lot of technical talk about deal structure, shares, and things that they expect you to know about and have ready at your disposal. So let us begin with kinds of shares that are possible. When you do a company, a startup, you probably know this already. You have a number of shares that your company has. Could be 5 million, 10 million shares, whatever. And they might be valued at certain pennies on the dollar, like 5 cents a share or 10 cents a share. And the whole point of that is to divide the ownership of your company among the shareholders. So if you're a founder of a company and you're the sole shareholder, that is unlikely to continue because, as we said the other day, when you accept somebody else's money, like an angel investor, then you are on a path to exit. You no longer can work on a what we call a lifestyle business where you work at your own pace. You kind of go along as you feel would be, at your organic kind of pace that you feel comfortable with. When you accept someone else's money, you are heading on a path to rapid exit. We mentioned the other day that an angel investor will want to get 5 to 10 times their money back in 2 or 3 years. Why is that? Well, because we will invest, for example, in 10 different deals. And of those 10 deals, 7 might fail and 2 or 3 might muddle along, or they might fail also. And if there's one home run deal in that 10, well, we want that home run to make 5 to 10 times our money, because in order to get our dollars back, we've already invested in 7 or 8 or 9 deals that have failed. That means we've lost our money there. So we need to make it up on this one. And that's why when you own the 100% of the shares of the business at the beginning, you're going to get diluted as you go along, because other shareholders will come in, they will buy shares. Even if your friends and family and relatives will support you in the beginning by buying shares, they're going to basically own a piece of the action as well. One rule of thumb when you're investor ready is do not give up any more than about 30% of your company in any given round of capital, because if you do, you will dilute yourself out of the deal sooner than the exit, and that will not be good for you. So shares are set up in a company to represent the ownership percentages. There are different classes of shares. One of the things that investors prefer is that you have a very simple share structure. Investors actually prefer a single class of shares, so that everybody, Class A common shares, for example, everybody then owns the company on the same equal basis, and they kind of toil away together. They take risks of the same kind, and they have the same rights and privileges that those shares offer. If you see a company that has Class A, B, C, D, E, F, G, and all kinds of different classes of shares with voting and non-voting rights, sometimes there's a necessity to do that, and sometimes advisors want you to do that, and sometimes you yourself as an entrepreneur want to do that, but it's not necessarily effective from the point of view of the investor. We want simplicity as investors. We want to see that everyone is taking the risk equally and not, kind of creating all sorts of different classes and so on. So shares typically are common shares or preferred shares. Common shares are the most common. They have certain rights attached to them. They can be voting or non-voting. They can be participate in different ways. They can have warrants and options attached to them, which are the rights to buy further shares in the future with certain privileges. So, for example, a common share might be worth 10 cents, but you might also attach an option or a warrant to each of those shares, allowing the owner to purchase at a later date shares at a certain strike price. And that strike price is the price that's specified. And it might be 10 cents a share, which is the current price. And so later on, when the company is worth more and your company's valuation has increased to the point where maybe shares are worth 20 or 25 cents, for you to be able to buy shares at 10 cents and then own them at 25, the lift, as we say, is 15 cents a share. So already you've made a capital gain, and that's exciting. So options, there's lots of different powers and authorities that accompany an option. So common shares can have those kind of strengths and privileges. Preferred shares are, as the name implies, given additional rights, and they can be a higher class of shares so that they might participate in dividends where a common share might not participate in dividends. It all just depends on the rights that are associated with those shares. Sometimes preferred shares are voting and common shares are non-voting. Sometimes preferred shares earn a higher dividend rate than the common shares. So different classes of shares have different powers and authorities and different benefits to the shareholder. You can Google this quite easily. There's all sorts of information available about the types of shares that there are, voting and non-voting, and participating and non-participating, and redeemable and retractable. There's a whole bunch of technical terms that we don't need to get into today, but if you need to know those, you will quickly learn that when you start to create classes of shares. Your lawyer or your advisor who sets up your share structure is going to help you definitely come to a conclusion as to what kind of shares you need and what sort of powers and authorities go along with those shares. So perhaps that's a few minutes on shares. The only other point I would make about shares is that it is very important when you're setting up a company to price your shares appropriately. And that's valuation. So the second hour today, we're going to talk about valuation, but I'll make a note here about shares. The price per share is something that is very important. Many companies set the price too high initially, or they run up the price. The second round of capital comes in. Let's say, you get friends and family money and you put in, I don't know, in your own money, you mortgage your house and suddenly you've got $100,000 in the company and you might price the shares at 10 cents. Well, therefore the company's value is, $1 million, let's say. Second round of capital comes in, some angel investors come in and they say, well, wait a minute, there's no revenue yet. Why are these shares 10 cents? We're going to offer 8 cents. And so you will have what you call a down round. And that's not good because the first people came in at 10 cents, they paid 10 cents a share. And then the second people came in and paid 8 cents a share. So you have what's called a down round, and it's not very attractive. So this is a cautionary note that pricing shares appropriately is important, because if you mess up on that, you're going to cause a problem for yourself in subsequent rounds of capital. So it's something to watch out for. I'm going to move to the topic of the cap table, capitalization table. Every company that is about to take on investors will need to have a cap table. And once again, you go on the websites, you'll find all kinds of samples about what a cap table should look like. But the essential elements of a cap table are that it should have all the different shares, not necessarily by name of shareholder, but that's usually informative as well. And certain investors will demand that from you. What are the names of all the shareholders? Because it is a matter of public record. And the cap table will then list all of the different shares. So common shares, class A, so-and-so many shareholders holding so-and-so many shares out of 10 or 12 million shares, whatever. And any options or warrants associated with the shares. So a cap table is a complete listing of all the different classes of shares, all the different types of investors that own those shares, perhaps by name, if it's not a huge company with thousands of shareholders. And the cap table will be on, preferably on what they call a fully diluted basis, meaning if you have 100 common shares and you offer, I'm making this up now, 20 shares in the form of options or warrants, well, the cap table will show 120 shares as being issued. The options or warrants shares may not have vested yet till a future date, but the fully diluted concept means that they're all completely shown, so that the complete dilution of the company, fully diluted, is shown. So the cap table is it's a one pager. It does not have to be hard copy. It could be simply an electronic file, but it needs to be kept up to date, and it needs to show accurately all the shares that are issued at any given moment in time. So the cap table, it's very, very important, because an investor will ask for that immediately upon deciding to conduct negotiations with you and entering into due diligence. They're going to want to see the cap table, and it's not good to have a messed up cap table. It's good to have it orderly and clean and clear and accurate and up to date. So the cap table it's a very valuable piece of information, and it's something that you will want to pay a lot of attention to. I'm going to move to a couple of additional words on options and warrants. There's some slight subtle differences between an option and a warrant, but for the purposes of a startup or an early stage company seeking angel investment, it's probably enough to say that an option or a warrant is an authority given to that share. So if you're the owner of a particular share and you have options or warrants, it gives you the right to purchase additional shares at a certain price called the strike price. And as you saw a minute ago, that's the advantage. You buy a share, and then you have an option to buy additional shares at an attractive price when the value of the company has later increased, and you're buying those shares at some fraction of that. It's a fantastic advantage. And so your investor will often ask you to accompany the shares they buy with options and warrants. The trick there is that it affects the valuation and the dilution. If you give somebody, say, there are 1,000 shares in the company and you give somebody 100 of those, that means you've given away 10% of the company. You now own 90% of the company. But the point is, if you have options and warrants associated with those shares, maybe 50 options, well, you've actually then at some point in the future, you will have given away 150 shares and you will only own 850 yourself. So there's a consequence to it, and there's nothing wrong with having options and warrants. In fact, it's usually a good thing because the investors are given a benefit or a bonus feature. They buy shares at a certain price, you get their money right away, and then they have the right to buy additional shares. So you get another injection of capital later on when they buy those shares, but they will buy them at an attractive price. So it's not as good as you selling those shares at the new higher price, but at the same time, you've gotten their first round of capital. Now you're going to get their second round, and you're going to have the benefit of a new capital injection. And they'll be happy because they're buying shares in an increasingly valuable company. And that company is going to be, they're going to be buying shares at a lower price. And so the company's going up in value. They like that. They bought some shares at a lowball price. They like that. And they've made a capital gain already. And if you were a publicly traded company, well, you could sell those, the investor could sell those shares fairly quickly and gain some liquidity. So the concept of an option or a warrant is attractive. It's also, I'll make a special note here, it's a way to help your employees. If you have set aside a percentage of shares in your company, and again, for any of you, Dale, who's live on the call, if you're thinking of having other additional employees at some point, one way to keep them sticky and kind of stuck with you, so to speak, to keep the retention rate high and to incentivize them is to give them some shares or sell them some shares, or give them a combination of giving some shares and selling some shares, or having them earn shares as the company grows or as their work progresses. But if you accompany those shares with options or warrants, that's also an attractive feature for an employee pool. We recommend as investors that you do not give more than, 10 or 12%, let us say, of your company as the percentage of shares owned by employees. It's not, obviously, if they become a senior partner and put in lots of money and want to invest along with you in a very significant way, that's a different story. But for the general run-of-the-mill employees, software engineers, or people who are important to your company in the early stages, like the marketing and sales people, to push revenue in towards the company, they will sometimes be incentivized by the possibility of creating some pool of shares that they earn or that are given, or some combination thereof. So I'm going to then now, I'll just pause if there's any questions. Dale, any questions from you? I don't see anything.
No questions.
Okay,
All good.
great. We'll just continue then. Thank you. So the next topic would be equity and milestone-based financing. We'll cover those together. So the concept of equity is that when you accept an investor's money, you're selling shares in the company. Therefore, that investor is said to have equity in your company. And equity financing is different than debt financing. So let us talk about those two things. We'll talk about equity first, and then we'll cover debt. The two are related. Equity-based financing means that when money comes in, people buy shares, the company gets that money, and it can use that money for, growth, expansion, anything that business development, product development, opening up new markets, adding features to products, improving the sales campaigns, adding value to the company in numerous ways. The equity participants, though, take the risk of that company in the same way as how I would put it. They take the risk. They own the company in the ups and downs of business. As things go up or down, they will ride with the company. And so if the company is wildly successful and their shares appreciate in value and go up in value, well, they're going to be successful and they'll be very happy. If the company comes into tough times, it goes on to the rocky shores, and there's some trouble. The market's changed, the business plan is not effective, or some crazy thing happens like a worldwide pandemic, then the shareholders who have equity in the company ride the company down as well. If a company goes completely bankrupt and shuts the doors and ceases operation, then the equity shareholders will suffer equally. Everybody just loses all their money. However, if you have debt financing, what happens with debt financing is that you're borrowing people's money. You're not giving up ownership in the company. You're borrowing their money. And so they will set a set of terms and conditions. They will set a condition. For example, if you borrow money and you issue what's called a debenture, the debenture will promise the lender that for the use of their money, you're going to pay it back over a certain period of time. It could be over a year or 3 years or 5 years or 10 years, just depends what you negotiate. And then you're going to pay interest. Of course, if you borrow people's money, you don't get it for free. You get the money, but you also have to pay interest on it. And so a convertible debenture is a financial instrument. Again, you can Google this and you can see all sorts of very good information about it. But a convertible debenture gets you money from an investor. You're borrowing that money, so you have to pay it back. But a convertible debenture is one that can be converted to shares at some point in the future. And so it therefore avoids the valuation question. Just jumping forward to the second hour today, when we're going to talk about valuation, it avoids the valuation question. You don't have to actually evaluate the company. You just borrow people's money, you pay them interest, and you keep growing the company. And at some point, according to whatever the convertible share, or excuse me, convertible debenture specifies, you're going to end up with some sort of an obligation. And the obligation could be that you pay all the money back, including accumulated interest, or they convert those debentures to shares at a certain price. Like there might be a discount. For example, if the shares are worth, I'm just making this up again, $10 each, the convertible debenture might convert to shares at $8. So you get a $2 discount. And so once again, it's a negotiation, but the point of debt financing is that you're borrowing people's money. You're going to have to pay interest on it. You're going to have to pay the money back, but you may also be able to convert it to equity, which means you don't ever have to pay it back then. You're just going to convert those shares to equity. And so they become equity owners working alongside of you, taking the full risks of up and down movements in the company. It sounds complex, but it's a very sensible idea of debt and equity. And of course, the other comment I'll make about debt and equity is that many companies finance themselves on a combination of debt and equity. So they might give away equity to the initial founders or an initial round of angel investors. And then later on, some people might come in and lend money to the company. And therefore, they will be debenture holders. And they might have some different rights to those debentures, all of which will be specified in the negotiated agreement. And again, the fun of investment and dealing with investors is that there's a great amount of creativity, and there's a great amount, of actual, I guess, choices and options and combinations. It can be mind blowing. Your head can explode with all of the different possibilities. But once again, when you're in the mode of seeking investment, you will become an expert in this yourself because you'll be facing the negotiation yourself. So that's a little bit about debt and equity. I want to make a comment about milestone-based financing. Milestone-based financing is a method of receiving money from an investor, but according to a set of milestones. In past years, if an investor came into the company and said, I'm putting in, I don't know, $1 million, you might get $1 million check. You put the check in the bank and then you start spending it over the next period of time in order to achieve your accomplishments. No longer does that happen. People will always do what you call milestone-based financing, which means that they will issue you, say, making this up again, $50,000 in order for you to achieve certain goals that you set out in your business plan. And it's a milestone based. When you achieve that milestone, whether it's time elapses, or you achieve a certain dollar figure of revenue, or you build a product and you finish the product and you get it out in the marketplace, and there's a milestone achieved, then they'll give you the next $50,000 to do the next thing. So it's a drip type method. It's milestone based. It's funding, not complete dollars. From the point of view of the investor, it reduces their risk. It de-risks their situation because you have to perform for them to give you the next dollar figure. It's actually not bad for the entrepreneur, because what often happens is if you get all the money up front, you waste it. You do too many things at once. You move off on 3 fronts instead of focusing on one thing, or the highest priority, or the highest yielding thing, and you run into trouble. So it's actually a good discipline. It's a discipline for the investor. It's also a discipline for the entrepreneur, because you have to perform. You've got to meet that milestone in 6 weeks, 8 weeks, 3 months, whatever it is, and you have to move with dispatch, and you have to be focused to get the result. So milestone-based financing is a form of de-risking for both parties, and it's generally good. So we're not really, as investors and entrepreneurs, you don't hear too many complaints about this approach to things. So I'm going to switch now to a few more topics, still on deal structure in the first hour of this, the minute book and the unanimous shareholders agreement. Let's cover those together. The minute book is a record of all the major decisions of the company. Who bought shares on what date at what price? In other words, inside of your minute book, all the information on your cap table is going to appear there, along with articles of incorporation, your certificate of incorporation, your annual filing that you do with your corporation's branch of your provincial government or your state government. You're going to have in your minute book all the resolutions that are passed. When you have an annual general meeting, you're going to appoint an auditor, you're going to appoint officers, you're going to appoint a board, you're going to make certain business decisions, and you're going to have passed resolutions with the decisions recorded and the names and the names and the type of resolution passed, who moved it, who seconded it, and that sort of thing. So a minute book it keeps the minutes of the meetings, is one way to put it. But it's more than that. It's everything that really governs the operation of the company. It's a track record. It's a chronicle of all the things that go on. Most early stage and startup companies do not pay attention to the minute book because they're busy building their business. They're just busy. And so the cautionary note is that when an investor comes looking and comes knocking on your door, they're going to look at your minute book, and it needs to be up to date. It needs to be current. It needs to be detailed. It needs to be accurate. It's worth paying attention to on a regular, ongoing basis. Once a month, you should pull out your minute book and update it. Put all the resolutions in, all the share certificates, all the decisions you've made as a company, in the governing of the company, as well as in the major directional changes, any monies, any cap table information, and so on. The minute book is a document. It's a chronicle. Sometimes it resides in your lawyer's office. Sometimes it sits there and it's updated by the lawyer according to your annual filing. It's actually better to keep the minute book yourself and update it, and to actually overload it with information. Skimpy, skinny minute books do not inspire confidence. They don't. No investor is impressed with a minute book that's 3 pages after 5 years with nothing in it, because you don't know then what's happened in the company. What will happen often is an investor will arrive on the scene, start looking at your minute book, and then query things, question things, and you will then have to go back into your files, find all that stuff, and you'll have to recreate it anyway. That's why we always say, get the minute book up to date, keep it up to date, do that on a regular basis, because you will anyway. Even if you don't want to do it now and you feel you're too busy, and yes, you are busy, and you may be too busy, but you need to keep the minute book up to date. It's a minor irritant in many ways, but it becomes a major problem when the check that you're looking for is held up because the investor says, wait a minute, this minute book is inadequate. I want it better. I want all the details. I'm not giving you the check. It's going to stay in escrow until, we solve the minute book problem. So it's one of those bookkeeping administrative things. It's a task that no one likes to do. It's a big hassle, but you've got to do it and you've got to pay attention to it. The unanimous shareholders agreement is another document. When you set up a company, you're going to have an incorporation in the provincial government, state government registry. You're going to have a certificate of incorporation, or what they call articles of incorporation, which are generic principles of the date and the time and the place and the purpose of the business. But more important is the unanimous shareholders agreement. It's called a USA, and for short. And the unanimous shareholders agreement sets out the process. These can be 10-page, 100 pages, 300-page documents. They are necessary in your business as well. Every startup needs to have a unanimous shareholders agreement. If you're a one-man show, one-person, launch, okay, fine. You'll just have a very simple unanimous shareholders agreement because you're the shareholder, and it will specify certain processes that you will have to accomplish. For example, if you're even a one-person company, your unanimous shareholders agreement will specify that you have to have an annual general meeting, and you have to pass a resolution appointing the director. That would be you as a director, and maybe an officer like a CEO or a marketing person. Well, that might be you as well because there's nobody else. It will also specify what happens if you die while in office, or if you become incapacitated, you get hit by a bus, you lose mental capacity, you suddenly are unable to function in the role. What happens to you? Compounding that, if you have multiple shareholders, and there's many of them, that's why we call it a unanimous shareholders agreement, because it must be agreed to by everybody before your company gets going or while it gets going. All the shareholders' processes then are laid out in a USA. For example, how voting occurs. Is it by show of hands, by person? Is it by shares? Do you allow proxy voting? Do you allow voting by shareholders to make decisions, or do you appoint a board and allow decision making by the decisions and the votes of a board? Who's on that board? Are the board members internal or external or a combination thereof? Are the in the unanimous shareholders agreement, what happens if you're in business with a bunch of shareholders and board members, and once again, one of you dies? Do you have the authority in your USA to negotiate to buy the shares of that deceased shareholder so as to avoid being in business with their estate? How many times have I seen in family businesses where people will die and let's say 2 or 3 brothers might own a business, or 2 or 3 sisters might operate a business. One of them dies, and suddenly the rest of them are in business with the spouse of the person who's deceased. Well, that may be great, or it may be a poor business decision. There may be friction, there may be problems. Somebody gets mentally incapacitated, someone is cognitively impaired and can no longer make prudent financial decisions for the good of the company. What happens to that person? What's the process for buying them out? How do you value the company at that moment in time so that you get the proper valuation, so that the proper price, the fair price, is paid for that share, so that the estate benefits from it, or the agents of the person benefit, and a fair price is offered and paid and received in the company. So long, I could go on at length, but the unanimous shareholders agreement, excuse me, the unanimous shareholders agreement is an important document. It takes a lot of prep. I have a summary. If you want to talk to me, there's a summary of sort of the 10 or 12 key points that must go into a USA. And all of them are, I mean, they're simple decisions in one sense, but they're complicated because you have to have consideration for the situation that you're in. How do you want to handle various things? One last thing I'll say about a USA that's important for an early stage or a startup company is what happens if one of the shareholders wants to sell their shares? To whom are those offered? And so there's these things called drag along rights and things like that that specify when an outside offer comes in to one shareholder, how that offer must then be shared equally with everybody else in the company. Similarly, when somebody inside the company wants to buy the shares of another person, perhaps they may have to offer that same deal to everybody else in the company. And so drag along rights, for example, if a major shareholder is about to exit, all the minority shareholders may join along and exit with them, because that offer might have to be extended to everybody. If it weren't, there would be an unfair situation created where the one party exits at a profit and then the rest are stuck. And so you've got a lot of subtleties inside the unanimous shareholders agreement that have to be dealt with. And it's an important document. It often is forgotten. It's often left on the shelf, once again, because people are too busy. But it's a problem. If you have an investor who's coming to do due diligence on your company and they see that the USA is incomplete, not done, not started, guess what's going to happen? They're going to insist that you complete the USA before they even come in. And they will maybe even have modifications to your USA because their money might come in on a conditional basis. So this is not to frighten anyone. This is just normal business. And if you understand the mindset of an investor, and remember the topic of this workshop is, are you investment ready? New investors coming in are going to want to not only offer their money, but in return, they will want certain conditions met. And so a USA often is changed and modified when new investment comes to the table. So it's it's an important concept. My suggestion also to you as a company is, don't go to your lawyer. The lawyers will hate me for this comment. Don't go to your lawyer and sit down and start talking about what goes into a USA, because the lawyer's hourly rate just starts clicking, click, 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 and you'll spend hours and hours discussing it. Rather, decide ahead of time, because online there's a million USAs that you can look at, templates, samples. Make your decisions ahead of time. Discuss it with your fellow shareholders, discuss it with your board, discuss it with your founders, discuss it with your investors or your family or your mentors or your coaches, your EIRs, your CASP, whoever it is that advises you. Discuss it all ahead of time. Have generally the decisions made, then go to your lawyer and say, paper this. and then you'll get a bill, but you won't get the thinking time bill, because you don't need to have your lawyer sit there and moderate and facilitate your discussions as you think your way through these complex problems. Better to know what the issues are in a USA. Like I say, there's samples out there by the ton. You can read any of these, and you can understand what has to be done in a USA to make good decisions. And you can then go to your lawyer, and you can save a lot of money that way. And lawyers, in fact, are advising that themselves. They're telling people, don't come to us and make us sit through days and days worth of discussion and dialogue, because you can't afford it anyway. It's going to be too crazy priced. So anyway, that's a thought about USAs. I'm going to move then to intellectual property protection, where to lodge your IP. So there's not a simple solution to where you should lodge your IP, but the topic of lodging the IP, holding companies and operating companies, let's consider those as a package, those three topics. So generally, when you do a startup, you're going to have what's called an opco, an operating company, and that company is going to conduct the business of building your product, warehousing it, selling it, distributing it, hiring the staff necessary to do all of the above, and to kind of operate the day-to-day business. A holding company, on the other hand, might hold your intellectual property, and that might be a different company, and it might be owned by different people. You might have, I'm just making up a family business example. You might have a family, some brothers and sisters that own the business, and they have a holdco, a holding company that owns the intellectual property, but then they might have an opco, an operating company that actually operates the business. And those are two separate corporations. And so therefore there's a structure, and you can get pretty fancy with this too. You can go to your tax advisors and you can create family trusts, and you can create a whole complex company that's what we call set of companies that we call tax advantaged. If you go to your tax advisor, they might say, in the case of Dale, I'm just going to use you as an example. You might have 5 shareholders someday in your business, and some employees, and you're going to own shares in your business. But your tax advisor might say, Dale, don't own those shares personally. Own them through a management company, which in turn owns shares in the holdco, which in turn owns shares in the opco. So you can see there's a lot of fancy structures that you can create. And when you get good tax advice, which we always advise, then you're going to have the advantage of knowing what we call tax advantage, the best structure for minimizing tax. And of course, that's what you want to do. You want to minimize your tax consequences of all your decisions. And you want to create a firewall between you and possible lawsuits and risks. If you own all the shares of your business personally, you get sued, or you get, you go bankrupt, or your company goes under, you yourself are at risk in so many different ways. Whereas if you have a proper structure in place, excuse me, you're going to have a proper structure in place to protect your interests. And so good advice there is important. But my point in today's discussion is that your intellectual property, if you have a particular patent or a particular secret sauce, type of process that is very proprietary to you, you of course should have patents and trademarks and other intellectual property protections that protect that property from being stolen by somebody else, or being, improperly used by someone else. But you will need to guard that. And so you may not put that in the same corporation as your operating company. You might have US and Canadian companies, for example. You might manufacture in one country and then sell in both countries, for example. And so you need to consider what sort of a corporate structure is necessary for that. And each of those structures will require shares and ownership and cap table and minute book and all that stuff. So it can become a very complicated process with multiple financial statements, consolidated financial statements, and other kind of processes annually that seem rather complex, but actually make sense from the point of view of reducing risk and creating tax advantages for you and minimizing the the damage that could be possible to you by major lawsuits or warranty claims or other disasters that can befall a company. So that's a little bit about holdcos and opcos. Once again, these topics at a certain level are pretty straightforward, honestly, once you start thinking about them. However, the more complex your business is, the more it grows, the more the number of markets, the number of products, the revenue and the size and the complexity grows, there's more decisions to be made in all of these areas. I'm going to then continue along in this first hour. I'm going to move to loans and more so dilutive and non-dilutive capital. Loans, we've kind of covered in convertible debentures, a form of loan, but there are other types of loans. There are lines of credit that you can get from banks. You can have private investors, angel investors, who will create a loan structure or a line of credit type facility that you could draw down as you need it, and then you pay interest, of course, and then you pay it back as revenue flows. And so those kind of loans are very important. But an even more important, particularly for early stage and startup companies, is to understand the difference between dilutive and non-dilutive capital. Everything we've said about equity financing is dilutive capital. You take people's money and you issue shares, everybody else gets diluted by some percentage depending on how much money comes in. But loans are non-dilutive in one sense, that they're still on the books, they're still on your balance sheet as a loan, and therefore an obligation, and therefore it kind of affects the valuation and how much your net worth is and all of that. But a loan is non-dilutive in the sense that it has no impact on the shares and the share structure. But a loan might rank higher in the event of let's say a distribution. You might have to pay when there's profit. Let's say at year end there's a profit and you have to distribute money. You might find that your loans are guaranteed first place in the distribution of profit. And so you have to pay off your loans first, or you might have to pay interest and all of that. Then, because it's an operating cost, then at the end, when you see the bottom line, then you may make dividends payable to your shareholders. And so, loans are, in a sense, non-dilutive in that they don't affect your, the value of the shares per se, but they do affect your bottom line and they do affect the value of the business. And so in a certain sense, loans have a dilutive capacity as well. But there's another type of non-dilutive funding for a business. And that's all these grants and credits and programs that governments have, federal, provincial, municipal. In Canada, in Western Canada, for example, in Alberta and in British Columbia, there are so many programs. There's one example is there's an individual in Alberta who is an expert on all of the non-dilutive grants and credits and programs and tax credits and forgivable loans and outright grants and paid pilots and all these things. The document that this individual puts out is a 100-page PDF file, comes out once a month. So there's 100 pages of information in Alberta alone about all of these grants and credits and so on. British Columbia, same thing. It's a vast list because governments are all in the business of helping entrepreneurs. And so you need to be smart as an entrepreneur. Every investor will ask you, have you maximized your non-dilutive credits and grants and so on? And your answer has to be yes. And so once again, it takes time. You're too busy. You don't have time, but you can get what is called free money. Now it's taxpayer money, and there's all sorts of discussion about whether that has any merit or not. There are also tax credits. There is an investment tax credit in British Columbia and in Alberta. When the investors put money into certain types of companies, certain types of investors, they will get a tax credit of 100 or 150% of their investment, for example. So it accelerates their tax advantage, but it also accelerates their investment into companies. So the point is, it's important for you as the CEO of a business to check out all these non-dilutive, all the free money, to take advantage of those, because it's good for you. Of course, it's free money, and it does not affect your bottom line. It doesn't affect your balance sheet. It affects your bottom line, yes, because you have money and you can use it, and you can spend it and help to create revenue from it. But the point is, it's something that is non-dilutive to your balance sheet. And as mentioned, every investor will ask you, have you maximized your non-dilutive? Investors are smart too. They don't want you to take their money and risk it unnecessarily. If you've gotten all the free money and you risk that first, well, obviously investors are going to like that. So I'm going to move along here in this first segment. We've talked about the classes of shares and the types of shares. I'll just make one more comment regarding the classes of shares. It's a reminder again, every investor will expect you to minimize the number of classes of shares so that you don't have a complex cap table, so that you don't have a complex array of powers and authorities and rights and responsibilities. Many investors will simply walk away if your share structure is too complicated. Some advisors still even in this era will push you towards having multiple classes of shares so that certain initial investors don't have voting rights, or they don't have rights to participate in dividends, or they have different powers and authorities. The mood among investors these days is, let's have everybody, all the shareholders, suffering or benefiting equally so that they're all aligned. It's all about alignment, and that's the code word that an investor wants to see. So my closing comment on this deal structure section, we're going to take a 5-minute break here, and then we'll come back and talk about valuation. But the code word for investors, alignment. Everybody needs to be aligned, rowing in the same direction, pulling in the same direction with the same rights and responsibilities. You start multiplying that and creating complex webs. You can do that. You have freedom. You're an entrepreneur. However, when investors come knocking on your door to do due diligence, they may ask you to fix that. And so, once again, you don't want to be doing that at the last minute when you need investment. You want to do that ahead of time. That's why, in summary, on this first section, you can Google and you can research all of this that we've talked about today, but have a clean cap table, have a clean and up-to-date minute book, and have a USA that's valuable, and have full alignment among all your shareholders, meaning one class of shares where possible, not even two classes, one class of shares. Everybody participates. That's a mantra. That's a rule of thumb that investors are pushing for these days. It's one that I personally agree with, because most cases we find there's no need for all this extra complexity that somehow has crept into deals in Western Canada over the last 20 years. No one understands why. There's some positive thinking behind it, I suppose. But in the end, what you find is that it doesn't matter. It really takes your eye off the ball. So that's my summary of the deal structure. So for those participants that are watching on video, we're going to take a 5-minute break. Dale, is that okay with you? We'll come back in 5 minutes and we'll continue.
Yeah, absolutely. Sounds great.
Okay, great. I'll see you in 5. I'm going to pause the recording and we'll stop the camera here. Welcome back, everyone. We're going to continue our third hour of the 6-hour workshop on Are You Investment Ready? And this fourth hour, the fourth hour, is on the topic of valuation, which is a very vital part of the whole thing. If you are building a company, you want your valuation to be constantly increasing, and you want it to be valued to be climbing. You want it to end up at a place where when you sell your company and exit somehow, when someone buys you, or you sell to your employees or to customers or whoever it is, you want the highest valuation possible for your business. And so I'd like to discuss with you then how we calculate value. There's different ways to do it, and there's different ways to do it at different times in the life cycle of a company. So the concept of valuation then begins with the notion that you are at a different point in the company life, creating value by producing your product or selling your service at a price that leaves you some margin so that you can cover all your expenditures and your investment in the growth of the company, bringing in new capital and all of that, and having value where the potential buyer looks at your company and says, yes, that company has increased in value. It's now worth, X hundreds or millions or thousands or millions of dollars. And so that you as a founder will exit. Now, as we said at the beginning of the workshop today, if you are trying to run a lifestyle business that organically grows at your own pace, you don't want outside investors, well, then you're perfectly free to run the business at the pace that you like. However, when you bring in outside investment, you always must realize that you are then on a path to exit, because no investor will come in, except maybe somebody who loves the lifestyle business that you have the same way that you do. There might be somebody that just simply wants to invest in you and patiently waits for their return on the pace that you intend to keep, or on an organic basis. But most professional investors, including angel investors, when they come in, they will want you to go on a path to exit. As we said earlier today, we want to make 5 to 10 times our money back in 2 or 3 years, because when we invest in a number of deals, most of them fail, or many of them fail, let us say. And so when that happens, we look for high growth companies. We look for valuation that increases rapidly. What are different ways to calculate valuation? At an early stage of the company, when there's no revenue, it's very difficult to use earnings or income. And we'll talk about that in a second. How do you value a company when it's at an early stage, when it's a startup and there's no customers yet and there's no revenue? Well, there's a couple of ways. One is what we call money in. And so if you are the founder of a business and you have financed the business yourself by putting your savings into it, mortgaging your house, getting a loan from BDC on the basis of your home equity or something like that, or getting non-dilutive grants and credits like we spoke of earlier today, and using, friends and family who might want to invest money in you because they are loyal to you and they care for you and they love you and they think that you're going to be a success, and they don't really care so much about your business pursuit as the fact that they want to support you in something that you're doing. So money in is something that takes into account everything I've just said. Money in, if you put $100,000 into your business, at that moment, the business is worth $100,000 because there's $100,000 of cash sitting there. But as the days and weeks go by, when you start spending that money and you start hiring staff or building a product or investing in a marketing and sales program, product development, licensing, intellectual property protection, bookkeeping, accounting, all that stuff, legal fees, you're reducing that money, and you may be exchanging that for intellectual property or a product that's improving all the time, and maybe even it's a finished product. When that happens, your valuation then becomes less about money in, but about residual value. So you might have a patent, you might have some intellectual property, you might have a a prototype. You might have something that's a working prototype. And so therefore it can be tested and you can have a little bit of confirmation from the market or traction from customers, or you might have a paid pilot to test that product in the field. So early stage companies have a valuation based on money in or on what you would call a residual value. You know, most investors will actually spot you a valuation. It's very common for investors to say, right, you're worth $500,000 because you've got this idea, you've worked away at it, you have put in the time, you've put in the hours and the months, you're at it for a year already. And yes, you have no revenue, but you know, for somebody else to duplicate that effort will take them a year. And so it's got to be worth something to buy you, even at this stage, because you have some kind of patents, you've got a product that's half finished or half ready, you've got software written, you've got a sales process in place, you've done some market analysis, whatever. That's at an early stage. As a company begins to sell product and receive revenues, then it's going to have to use a different type of valuation. And so there's something called the earnings multiple, and it's also known as the net present value of a future stream of income. So a little bit of a technical topic, a bit scary, but if you think of the concept of simple earnings as a proxy for valuation, here's how it can work. There's many ways, but this one is very typical, particularly of a manufacturing or kind of a process business. Earnings before interest, taxes, depreciation, and amortization. That is called EBITDA. EBITDA, you hear some people say. EBITDA, earnings before interest, taxes, depreciation, and amortization. So earnings is basically sales minus cost of goods sold and admin costs. And then there's some kind of bottom line, profit. That's called earnings. Earnings times 3 to 5 times earnings, 3 times earnings, all the way up to 5 times earnings, is generally a proxy for value of a company that's in revenue, making sales, and is profitable. When that company is reviewed by an investor, they will often use that 3 to 5 times EBITDA as a proxy for value. And notice that's different from what we said at an early stage. It's possible to use combinations of things. We'll get to that in a moment. But the more technical term of the net present value of a future stream of income is similarly a way to calculate valuation. So it's different than the earnings, 3 to 5 times EBITDA. Another way of doing valuation is to find a stream of income going into the future. So that's your forecasting. If you have a very good spreadsheet analysis and a way of simulating a bunch of different cost and revenue scenarios, by the way, I urge you, develop the capability to have excellent pro forma financial statement simulation capability. I want you to be able to put all of your revenues of all your different product lines by geography, by vertical, by segment, whatever, and all of your different types of expenses into a spreadsheet. And I want you to be able to simulate various scenarios, high, medium, low, different mixes. It's not that complex. QuickBooks Online can be very useful in this regard, or something like that, software like that. But you need to have full facility in figuring out how to do all these scenarios, because my recommendation to you is that you always, on every monthly financial statement, have a category at the bottom called valuation, using some kind of a method of calculating valuation so that you can simulate and any action that you're going to take as to its impact on valuation. This is not done very much in companies. And so we need to start doing that so that you are aware of the valuation of your company and you're aware of the impact on valuation that every step you take has. The investor will be interested in this too. They will come to you and they'll say, okay, I want to buy your company. I want to discuss buying shares in your company, whatever. Let us calculate some scenarios. Let us see. So once again, it's one of these things where if you don't already have this capacity built into your company, and we're all busy and it sometimes gets left aside, if you don't do it now, your investor is going to want you to do it. They will ask you for scenarios. Okay, show me some scenarios of how adding product line or adding geographic market or adding features or cutting costs or raising costs or adding 5 salespeople. What's the impact going to be on the financial statement of the company and therefore on valuation? Because that's what they're looking for. When an investor puts money in, they're thinking of the valuation of the company at a certain point in the future, whether it's at an exit point or at a milestone that is previously agreed to. So we've got this method of the third method. Then remember, the first method is money in, our intellectual property or sort of intrinsic value. Second is the EBITDA times 3 or 5 or somewhere in between. And then you've got this future stream of income brought back using a deflator to present value. It's complicated mathematical formula, but if you look at it online, you will find formulae that allow you to calculate this. And the idea is you simulate out to the future, 3 to 5 years, 5 years maximum. Nobody believes any kind of projection actually beyond 3 years, but it's acceptable to show investors up to 5 years of valuation because that gives them a sense of the trend based on different scenarios. And if you bring that future stream of income back to the present value, you can also find a way of evaluating. And the concept, maybe you already get this, and I don't mean to be repetitive. Apologies if it sounds that way. But if you get $100 a year for the next 5 years, that's not the same value as $500. It's not the same value as a number today. If I give you $100 a year for the next 5 years, what's the value of that? It's not $500. It's a smaller number. It's 350 or something. And so that's how you compare net present value. It's the futures, the value, the present value of a future stream of income calculated back versus having those dollars today. That's the concept. I know you can look it up and you can find out. But why is it important for the early stage company or the startup? Well, because the investor will ask you to do scenarios of, okay, let's see how much income is going to be produced in the future. How quickly can this company grow? What will the sales be under various scenarios? And then they're going to see what the bottom line is. And then they're going to do the present value calculation. And they're going to come, to a conclusion about that. Another method of valuation, usually used for publicly traded companies, which you're not generally, startups are not publicly traded, but it's the earnings multiples, is similar to EBITDA, but it's a kind of there's a price earnings ratio. There's the earnings, which is more of a, for stock market companies, earnings is kind of like earnings before interest, taxes, depreciation, and amortization, but it's a multiple of earnings. And so you will have heard, everybody's heard of this. I'm quite sure you all have, some software company was sold at 100 times earnings or 20 times earnings. And that is considered fantastic. Or companies valued at 1 times earnings. Sometimes software companies or service companies are valued at 1 times earnings. And if you can offer a premium above 1 times earnings, well, you're going to be attractive to investors. So there's a lot of different methods of calculating. There's the future earnings potential as a concept, not as a formula. Future earnings potential. If you can show your investor that the company is worth something today, let's say you have an EBITDA times 5, and that's a valuation today, but you're going to actually expand into 3 new geographical markets. And so your earnings are going to just take off on a very sharp upward growth curve. You could show earnings potential for the future of the business. Another valuation approach is what you call replacement value. So I don't know, if you take a house as an example, the residential real estate market, houses are valued on several bases, right? One is current sales. What are the sales in the neighborhood going for the similar house? That's a measure of the value that you're going to get for that house. You will not likely get more than that for your house. But there's also replacement cost, which is if you had to build that house from scratch, what's it worth? And in some cases where some markets, it's just the land value. the house will be knocked down and a bigger house will be built on that site, or a multiple dwellings will be built on that site, like a duplex or a triplex or something like that. And so you have this concept of replacement value. Once again, you can study all sorts of different methods of valuation. My recommendation to you today about valuation is to look at several different approaches. Value your business according to several different ways. And so if you're at a certain stage of life in your company, money in, if you already put $500,000 into your business, well, that's an approximate value of it. If you have already, and you own patents or intellectual property of some kind, the cost of that or the value of that is part of valuation, the current value of the company. If you have some sales, even a few dollars of sales, you can start to do the EBITDA, or the multiples of earnings, or the future potential earnings, because you can simulate some future directions for the business. What we recommend to you as an entrepreneur is have 3 or 4 methods of evaluating your company. Discuss them openly with your investor. When an investor comes to see you, they think they know how to evaluate your business, but they probably don't, unless they're absolute experts in your particular type of company. And so what we urge you to do is, think about several ways, maybe take an average of them. That's too simplistic maybe, but you could show your investor that you've got several different kinds of value in methods of evaluating your business, and therefore you can come to a discussion or a negotiation armed with some facts and some strongly held opinions that you can back up. Because valuation in general is a negotiation. It is not simply a mathematical calculation. There are professional business valuators out there. They are people that have certification and a lot of skill, and they can be expensive or inexpensive, depends. But they use a lot of these techniques, and they have a specialty in understanding a certain segment, a certain sector, a certain kind of business, and a certain stage of business at its life cycle, where they are, if it's an early stage startup, or it's a mature company, or a company poised to exit, or a company at the end of its life, or a company at the end of its product life, because sometimes products move in and out of fashion and utility. And so there's a lot of different factors that these professional business valuators take into account. That is a service at some point that you may require. If you're going to sell and you're already making several millions in revenues, your investor or your exit people that you're negotiating with often will want you to, value the business using the services of a professional valuator. And so if that's the case, you need to have not only that information, but you need to bring together all of this other these other methods and this other approach that you might have. I'm going to turn briefly now to calculating that on your financial statements. Mentioned a few minutes ago, I really urge you to figure out a way to put in your monthly financial statement some kind of valuation figure. I often just suggest, if you take the earnings multiples or the EBITDA times 3 to 5, have a line at the bottom of your financial statements. You've got all your revenues on top, all your costs, cost of goods sold, G&A, general administrative costs, and you'll have a bottom line. And so below that, I urge you to put a financial statement in place that, or a calculation in place that shows a number, and that number then will be able to give you a proxy at any given month as to valuation. So that's an idea for your consideration. It's not foolproof, but it gives you a signal about every simulation or every situation. If in 2 or 3 months of successive financial statements, even though you're profitable, but there's a certain thing happening, you might see that the valuation number declines. And so you might want to take action on that. I'd like to also introduce another concept to you in financial tracking. 2 things. One is that it is very important that you create a financial dashboard. I know I'm straying a little bit into finances here, but on your monthly financial statements, I urge you to create a monthly, if not a weekly, metrics of a dashboard, 5 or 6 key indicators, whether it's key ratios, cash, valuation, or various other detailed information, all coded, color coded, red light, green light, yellow light, or up down arrows, excuse me, that indicate to you the health of your business. It's also part of the valuation process. If you are able to do that on your regular financial statements, you will not forget about valuation. It's easy to forget about because we tend to focus on the micro details of that month's financial statement, or even the trends, even the more macro kind of overall effect of a financial statement, let's say an annual financial statement. But if you don't have this dashboard set of metrics in front of you on a regular basis, you can be caught off guard. Value might be plummeting and you're not really aware of it because you're not looking for that in particular. So that's one thing to do. The second thing to do on your financial statements is to create a system of tracking valuation according to key ratios. So I'm not going to give you an accounting lesson today, and I'm not an accountant either myself. I'm an investor and an observer and an analyst of companies. But if you look up on various websites, including Investopedia is a great source for this. There's all kinds of accounting ratios that should be looked at in your regular financial statement review that help you to understand the health of your business. One important one is called 12-month trailing averages. A financial statement, an annual financial statement, is a record of what happened in the 12 months that comprise your fiscal year, right? 12 months is an annual fiscal year, whatever your start date is, January, March, whatever. You're going to have a pattern. You're going to have some kind of monthly breakdown. You might even chart it as part of your dashboard metrics. You might chart that and show yourself every month, what are your costs doing? What are your profits doing? What's your revenue trend? What's your expense trend? What's your valuation trend? It's all very important. But the 12-month trailing average approach removes the effect of seasonality or the effect of this 1 year, 12-month snapshot. A 12-month trailing average is the preceding 12 months. It's that simple. You redo your financial statements on a consolidated basis, or you do your trend analysis, you do your metrics, your dashboard on the basis of the preceding 12 months, wherever you are at this date. So this workshop is coming to you at the end of March 2021. And so you would go back the previous 12 months and you would do everything on what is called a 12-month trailing average. Next month, you would move ahead 1 month and you would do your analysis once again on the preceding 12 months. It removes seasonality. It spots trends quicker. If you only did a snapshot of the preceding 12 months, actually March of 2020 April 1st of 2020 to March 31st of 2021, you're going to get the pandemic year, right? But if you only look at that year, you're only going to see the effects of the pandemic, but you will not have anything to compare it to. And if you try to compare it to 2020, yes, you'll see some difference, but you won't know much detail about when it happened or how it happened. Whereas if you do a 12-month trailing average, you will instantly see which month the trend happened. When did your revenues stop? When did your supply chain get damaged? When did your costs, increase? When did you start getting free money from the government, which hid your actual damage that was done to your business? The 12-month trailing average, don't want to oversell it to you, but it's a useful concept, as is a diagnostic that you would perform on your company to remove all the free money. I urge you all to do this. Take a look at the last year and take out all the free money that you got, all those loans, all those, let's call it free money. Take that all out redo your financial statement and see what it actually looks like. And you will be shocked at the impact on the health of your business. And I hope I hope your year was good, but at the same time, it might have been troubled, and you might have blended in all that free money, and you think you have a financial statement, and you do, but it would be better to take that all out and see what the company did on its own without the free money. So why am I deviating off into this discussion of financial statements and some of these financial metrics and indicators? It's because it all contributes to valuation. If you're talking to an investor, they're going to want to discuss all these different methods of valuation. They're going to want to look at your financial statements, and they're going to want you to dig into, how the impact of particular measures, ratios. There's a lot of them. You could once again refer to Investopedia and other sources to find out the valuation effects of different ratios on your business. You do not need to become an accountant. You don't need to turn into a professional accountant, but you do need to have more familiarity with how the impact of financial statement elements are on your valuation. And I call it financial literacy. It's important that we become more literate in interpreting our financial statements. And there are ways to set it up so that it comes to you interpreted. You as entrepreneurs are very busy people. I admire the entrepreneurial spirit very much. And I know you're all swamped with your business. It's more than a 9-to-5 job. But you can create financial statements and valuation scenarios that are automatically calculated for you, and that come together, on a monthly or a weekly basis, color coded, to show you the health of your business and the trends, and lots of details that will help you to understand the impact on valuation. So I'm going to pause there for just a moment, and I'm going to see if there are any questions from Dale. You're live. Would there be any questions where we are at this point in the conversation?
No questions at all. It's been very informative for sure.
Okay. All right. Thank you. Well, let us then take a look at, let's just take a look at a few topics, more miscellaneous topics in the remaining minutes that we have. And we'll take a look at these. We'll take a little review here. So in the first hour of the 6 hours, we talked about the process of negotiating capital. So we talked about the pitch deck and the format and structure, the story that you tell, the various mechanisms and financial instruments, how to communicate with the investor. I'm going to spend a few moments on that now. We're going to, in fact, add to the communications information that you might like to have in your business. We talked in the second hour about the life cycle, the rapid exit, the going public, the lifestyle businesses growing by organic, growing by acquisition, early exits, hanging in for the long run, all of that. In the third hour this morning, we talked about deal structure. And so different types of shares, cap table, options, warrants, holding companies, opcos, holding their IP, anti-dilution mechanisms, and so on, different classes of shares and kinds of shares. In the fourth hour, just now, we're talking about valuation and the different methods of valuation. I want to continue now in this fourth hour with communications. There are many lessons about communications. One of the most common complaints that investors have is that companies they communicate intensively at the beginning. They're all over the investor, they're talking, they're updating, they're constantly, there's a flow of communications and information passing back and forth. But what happens is that when the tough times hit, or when things get a little bit challenging, then communications slow down or stop. It's a common complaint of investors. I urge you, do not, if you're going to start communication with your investors or your prospective investors, and you're going to send them, you're going to put them on a mailing list, you're going to send them updates and information, you will hear from investors quite a bit. Yes, we're not exactly interested in your company right now, but we want to monitor you. We want to watch and see how you're going. And so you're going to put them on a list, and you're going to figure out some kind of regular communication method. I urge you to become expert at that. And don't stop. When the messaging becomes a little more challenging, or you have bad news to report to your existing investors or future investors, you need to be candid about that, and you need to be particularly with existing investors. You don't have to broadcast to the world your business troubles. No, it will come out in due diligence anyway. But to your existing investors, I urge you to have a communication strategy that is forthright, quite open and honest and transparent. And there are several ways you can do that. One is you can have regular communication. You can have, I don't know, monthly, for example, a newsletter, confidential, private website or a private link to information that helps your investor understand the state of your business. And the reason we do this is because sometimes when we need a cash injection, the best and easiest place to go is to existing investors. They are the ones that already know the company. They've already made the investment decision once to come into your company and put money in, whether they lent it to you or took equity position. But the point is, they often are the people we go to first when we need new capital, and often they're willing to do that. So how do you make sure that you have that possibility open to you? Well, you keep a regular flow of communication going with them. What should be in your communication? Well, certainly overall trend, overall mood of how things are going, traction, and all of these positive things, all the press releases, all the awards you win and all that stuff. It's all good. But you also want to make sure that you have a certain kind of reporting. And so you need a financial statement review. You don't have to publish the whole financial statement necessarily, but you should have a financial statement summary, and you should have certain market information available. Like, what are the market segments? What is the take up in the marketplace? What are the unit sales? What are the dollar sales? What are the dollar sales by geographic location, by product line, things like that. It's better to over communicate this than not. What we find as investors that most companies don't do this well. They gloss over this type of thing, and they try to predict for us as investors that everything looks rosy. And there's an element of that. We do have to have optimism, and we expect that because you're all entrepreneurs and you have the entrepreneurial spirit, and we believe you. And that's why we're invested in you, or that's why we're considering investing in you. The thing is, though, you have to be able to tell us factually, because we may not be as expert in your business as you are, but we do know what we're talking about in many ways. And we can tell when we're being, when there's BS going on, we can tell. And so I urge entrepreneurs who want to be investment ready to be a little bit more detailed, a little bit more open book in the financial information you share. Now you have to protect that, and so you would have it on a secure site or on a special link or whatever. Yes, you should do that, but you should have regular communication. You should have clear communication. You should include forecasts. You should include decisions that your board has made that can be made public. I presume that there's nothing too secretive about this. And you should also do market surveys, market scan information. So my point in here in this section is the communication with your investors, existing and potential, is more important than you think. That little tendency for people to stop communicating when the bad news starts or when the tough times hit is something to be overcome. We need to try to be better at that, because the challenge you have there is that it's problematic. It's we can sense this thing as well, because we as investors are observers of the situation too, and we want your company to succeed, and we want to hear the bad news as well as the good news, which then leads me to one of the final 2 or 3 points. The best investors to have are going to be, and we'll speak about this next time we meet, we're going to talk about the different kinds of investors, but today I'll talk about the best quality of investor to have. And that is that just as much as they are tire kicking and doing due diligence on you, I urge you as entrepreneurs to do due diligence on your investor too. Ask them questions like, how did you make your money? What lessons did you learn? Where did you invest? They're not obliged to tell you their whole history, of course, but you could ask for some important lessons from them. Where did you make your money? How much credence did you give to business plan, versus, product or technology, or the team. Remember, we spoke about the team being the most highest contribution to value comes from the team. I'll spend a few moments on that. The Kauffman Foundation a few years ago did a study on contributions to valuation of about 10 different factors. And the factor that came out on top was the team. The business plan and the technology actually were far down the list, number 8 and number 9, something like that, because the initial business plan, the initial product, it all looks good. But when you put it out into the marketplace, the reality of the world hits then. Changes can occur. You can have a global pandemic that suddenly sweeps the world and changes the market and changes the picture, the profile of where you're going. And so what you find then is that you have this notion that you had an expectation, but it has disappeared on you. What's the key factor that's going to improve valuation at that point? The team. How quickly can they respond? Are they resilient? Are they tough enough to take it? Are they creative? Are they smart? Can they regroup? Can they figure out a way out of that problem? That's the test of a business, more so than its market, its business plan, its productivity, its technology, all these other things. So again, I'm urging you to pay attention to the team, even if it's a one-person show. The skill set that individual shows, the resiliency, that's often what attracts the investor in the first place and keeps the investor engaged, so that when a crisis happens and they know that they have a resilient CEO and a resilient team that's creative and is working hard to figure the way out of the solution, the investor might invest more, which might be counterintuitive. It might be a surprise to you, but that often happens. Existing investors are the ones to go to put more money in. If they have been communicated to very well and wisely, regularly, completely, openly, and if they know that you're resilient and that you continue to work with them and you seek their advice and their input and you do your due diligence on them as well as they're doing on you, you might find that the investor is with you for the long haul. Because remember, they are the believers in your company too. They have put their dollar, they've written actual checks, and they want to work with you and they want you to succeed. So they're not the enemy. They're not people to be avoided when the hard times hit or the news gets tough. They're actually to be cultivated during those times so that their wisdom can shine through and they can help you. So that's a little blurb on communication, which is an art form. There's a science to it too, yes, but generally it's an art form. And so I urge the CEO, particularly the leader of the company, to reserve some time. You're very busy, you have a million things going on, but it is very important that you reserve a certain percentage of your time, and I'm thinking 5 to 10% of your time, in communication with your key investors or with your key potential investors or your key investors for the next round. Let's say you're doing angel financing now, but you're looking at venture capital for the next round, or you're thinking of going public, or you're thinking of getting bank financing after you've achieved a certain level of income and revenue and cost control and so on, and you're going to go for a bank line of credit. All of that requires communication. It requires trust, and it requires you to be open and candid and honest. And you cannot hide anything. If you try to hide things, we figured it out. People will see that immediately. And so I urge you to have good formal communications processes that are open and honest and candid, and that are frequent and regular, and that are tailored to the needs of your investment group and your future investment pool of people. So I'm going to, I think, wrap up there. We've covered the topic that we want to do today. I'll just ask one more time if there are any further questions. And if not, we're then going to wrap up our session, and we will return next time with 2 additional topics. And I'll just remind us what they are. Number 1 is going to be next week, hour number 5, which is the profile and the mindset and the kinds of investors out there. This is an important topic because there are many, many different kinds. There's a huge maze out there of the type of investors and the number and the quantity and the location. And you need to be smart because you don't have the time to go figure that all out. You have to zero in on the right group of investors for your type of company at your stage of business. And so we'll talk about that next time. And then finally, we'll close in hour 6 with due diligence, the deal room, term sheet, NDAs, the investor package, and things like that. And another reminder is that this course, Are You Investment Ready, is actually preparatory to the next course, which is available also at CAST. And it's the thing about the 12 key question investment pitch deck. That is a whole process of its own. That's a 10-hour course, and there's plenty of homework there. The end result of that one is that you will end up with a high quality pitch deck that's investor ready. And so that's a little commercial for that. With that note, are there any questions? Dale, you're online today. Anything else from you at this point?
No questions at all. I mean, it's very informative, great information, very much appreciated. So thank you for taking your time.
Thank you. Thanks, Dale, very much. And for the others on the call, so Harumi and Sammy and Jordan, when you're looking at this, if you have further questions of me, don't hesitate to email me or phone me or text me, and I'll be happy to discuss them with you. So we'll conclude this session today then. Thank you very much for attending, and we'll see you, I think it's next Monday, and we'll do the final 2-hour segment of this Are You Investment Ready course. Thanks very much for being here, and we'll see you all later on. Thank you.